Hi, and welcome to the FXTrade.com Beginner's Corner. We are going to talk a bit about how to access the Forex market, okay? Individual traders are known as retail traders or retail customers. These individual currency speculators that trade for their own can't access the interbank market directly, and they need a third party to be able to exchange the currency. This third party is a broker. A broker is usually a firm or individual who executes orders to buy or sell currency contracts on behalf of clients and, of course, charges them a commission. As retail trading grows exponentially, so do brokers. Over the years, scams have doubled the number of reliable brokers, and with that said, since the 2007 crisis in the United States of America, regulations and control have been tightening up across the world. As these companies hold the capital of huge amount of self-traders who come to the Forex market with small knowledge but big aims of becoming rich, and due to the mentioned surge in scams, central banks have been adding regulations and control mechanisms in order to protect individuals. Anyway, how does the broker charge its services? Well, with what we know as spread. This spread is the difference between the buy and the sell prices at a given moment for a determined currency pair. The spread is measured in pips. A pip is the smallest price change that a given exchange rate can do. It's the acronym for price interest point, and it's represented by the last decimal point of a currency pair price. Almost all currency pairs have 4 decimals, so if we talk about euro and dollar, if current price is 138.08, once it reaches 138.09, it has rose 1 pip. While its price is down to 138.07, then it has lost 1 pip. As an example on how a broker charges commission, if we have a 3 pip spread on euro dollar, this is how it will look like. I will be seeing a selling price of 138.05 and a buying price of 138.08. So, if I want to buy euros against dollars and the belief price will rise, I will be buying the cross at 138.08, right? And at the same point, I will be losing the 3 pip spread the broker charges me for the trade, right? So, to win 10 pips, I will then need the price to reach 138.18, 138.21. Why? Because at the time of closing my position, I will have to revert it, right? Meaning sell at 138.18. Price then will have to move the 10 pips I want to win, plus the 3 pips of spread the broker charges to reach my target. Price then should write 13 pips in order to profit 10 pips. This usual 4 decimals concept has an exception. Japanese yen crosses, where they are presented with 2 decimals. As you can see in this dollar Japanese yen example, the selling price is 80.80, but buying price is 80.83, that 3 last being the pips named as spread. Now, let's see some important concepts related to the Forex trading, right? Through a practical example, we are going to define margin call, and leverage. As we said in our previous video, leverage is having the ability to control a large amount of money using very little of our own capital and borrowing the rest from the broker. Said in another way, it's a credit or loan that is provided to any investor by the broker that is handling his or her Forex account. As an example, and to trade, meaning buying or sell 100,000 of any currency, an investor needs to give $1,000 to the broker. This amount of money is considered a guarantee of the total amount of money that investors will trade. This guarantee is called margin, or more precisely, use margin, since the $1,000 deposit is margin you have to give in order to use leverage. So, the broker will set aside those $1,000, right? And now the difference between the total capital on my trading account and the warranty given to the broker is called the available margin. The required margin to trade is usually expressed in percentages. In this case, this margin is of 1%, right? Because it's the amount of money your broker requires from you to open a position. I gave $1,000 to buy $100,000. Okay? Based on the margin required by your broker, you can calculate the maximum leverage you can will for your trading account, right? Usually, the leverage is presented by a ratio. In our example, it could be a leverage of 100 to 1, as I gave $1,000 to my broker to control 100,000. I know these concepts are a bit confusing as we use margin in several senses, right? Let's see if we can illustrate with an example so we all understand all these very important concepts. Let's say that I start by opening an account of $1,500, right? And I want to open a position, right, of $100,000 against euro, right? Meaning my required margin of 1% and with the leverage of 100 to 1 will require a margin of $1,000 for that trade. Let's see what happens. I have $1,500 in my account. I give $1,000 to the broker as guarantee, and that leaves my account in $500. At the same time of opening my position, the broker charged me 3 pips spread, in this case $300. That leaves my account in $200. That's money that is available to open a new position if I want, meaning the available or usable margin. Okay? Yet, unfortunately, the price drops. So, that's the contrary to what I was expecting, right? And I'm losing money. In this particular case, when the price dropped just 2 pips, my position is automatically closed by the broker. Why is that? Well, the broker trading platforms have the ability of automatically generating a margin call. When my account equals 0, the trade will be closed by the broker as there is no more available margin, right? My available margin was of $200. The 2 pips I lost represent $200. My account reached 0. I get a margin call, right? Anyway, at this particular moment when the trade is closed, the broker will then unlock the $1,000 that I had given him as a warranty and is credited back in my account. My account then will be of $1,000. Okay? However, I have lost $500 in a single trade. Here is a small summary of all the operation we have just described. So, consider this. Leverage is a double-edged knife. Why? Because it can make you win big, yes, or you can also lose big, right? Getting back to our earlier example, if the euro had risen 20 pips instead of dropping 2, yes, I could have made $2,000 profit. But in this example, I lost 33% of my capital, meaning 1,500 less 500 in a blink of an eye when the currency fell just 2 pip. Okay? In here, you have a small summary of all the concepts we have been using till now. Anyway, and to continue with this leverage issue, we need to talk a bit about the risk, right? The risk depends on the amount of money we decide to involve in each trade, right? And of course, related to the total capital of the account. In our example, the $1,000 traded represented 66% of the total account. With a larger account, however, let's say it's a total account of $10,000, those 1,000 we have risk represent only the 10% of the account, being then much less risky, right? With the same amount of money, but related to my account total, the proportion of money that I put and the risk is much less. Common sense suggests for a beginner not to risk more than 2 or 3% of the account per trade. Experienced traders used to work in between 5 and 10% of their total account and no more. As an example, with the same 1,500 account and a leverage of 100 to 1, I can choose to buy not $100,000 at $10,000, right? And in that case, my warranty will be of just $100, leaving 1,400 free. In this case, each pip market moves will represent just $1, and the pair will then need to lose 1,500 pips to trigger the margin call. To limit that kind of risk, trading platforms include automatic trading orders called stop loss. Stop loss is the price at which we decide to cut losses. We set this order on the platform at the price where we want the broker to close our position when the pair is reaching the maximum amount of money we are willing to lose. As an example, again, if I buy euros at 138.08 and I'm willing to risk or lose no more than 30 pips, my stop loss should be then placed at 137.38. Trading $10,000 and following the previous example, 30 pips will be a $30 loss. My account will then be reduced from $1,500 to $1,470. The other automatic order I can place in my trading platform is a take profit or limit order. This is the level where I want to grab my winnings and move out of the market. Following the same example, if I want to make 10 pips, my take profit will be then 138.18, right? Once the price reaches that level, the broker will execute my order and my account will be then at $1,510. Why would I put a limit to my gains? Well, because I know this profit is good enough according to my previous market analysis. Price fluctuates very heavily, as we said, up to 18,000 times per day, so there is a possibility of a price reversal. Long story short, I could win more, but I could also lose again. So I prefer a small or medium gain than a loss. To take a practical overview of all of these concepts, please watch our next video, okay? Thank you.